Imagine waking up tomorrow morning. No alarm, no commute, no boss, no emails, no meetings. Yet money still arrives in your bank account. Not because you worked yesterday, not because you sold something, not because you launched another side hustle. The money arrives because you own assets. That's the dream. And for millions of investors, dividend income feels like the closest thing to financial freedom ever invented. Buy stocks, collect cash, retire early, live happily ever after. Simple. At least that's how it's usually presented. But there's a problem. Most people only see the dividend payment. They never see the portfolio behind it. And once you start looking behind the curtain, the entire story changes. Because living off dividends is both easier and harder than people think. Easier because the strategy itself is straightforward, harder because the numbers are often shocking. Today, we're going to uncover the truth about living off dividend income, the math, the risks, the myths, the hidden traps, and why the people who successfully live off dividends often think very differently from the people trying to get there. Chapter 1. Why dividend income feels so powerful. Let's start with a simple question. Why do people love dividends so much? The answer isn't finance, it's psychology. Imagine two investors. One owns a stock that rises 10% every year. The other owns a stock that pays cash every quarter. Even if both investors earn exactly the same return, many people prefer the dividend. Why? Because cash feels real. Watching a stock rise feels theoretical. Watching money land in your account feels tangible. It feels like progress. It feels like you're getting paid. And that feeling is powerful. Dividend investing turns ownership into income. Instead of waiting years to sell assets, you receive small rewards along the way. That's why dividends have become the centerpiece of countless financial freedom strategies. But before we go further, we need to understand something critical. Dividends are not free money. When a company pays a dividend, it is simply distributing part of its profits to shareholders. The money comes from somewhere. It comes from real businesses selling real products and generating real profits. No magic involved. Just economics. Chapter 2. The dream everyone is chasing. The dream is freedom. When people say they want dividend income, what they usually mean is, I want my money to work harder than I do. That's a very different goal. People want choices. They want security. They want control over their time. They want the ability to walk away from jobs they hate. And dividend investing appears to offer exactly that. You buy assets, the assets pay you, the payments cover your expenses, you become financially independent, at least in theory. But theory has a habit of colliding with mathematics, and mathematics is where most people get surprised. Chapter 3. The $1,000,000 Reality. Suppose you need $5,000 every month to live comfortably. Not extravagantly, just comfortably. That's $60,000 per year. Now let's assume your dividend portfolio generates a 4% yield. To produce $60,000 annually, you need approximately $1.5 million invested. Not $150,000, not $300,000, $1.5 million. That's the first reality check. Most people aren't struggling because dividends don't work. They're struggling because accumulating $1.5 million is incredibly difficult. Now increase your lifestyle. Maybe you need $8,000 monthly. Now you're looking at roughly $2.4 million invested. Suddenly, the challenge isn't dividends. The challenge is asset accumulation. And that's where most financial discussions should begin. Not with dividends, with building wealth. Chapter 4. The Social Media Illusion. Open social media. You'll see screenshots everywhere. $1,000 this month, $5,000 this quarter, $10,000 in passive income. What you rarely see is the portfolio value. Someone earning $40,000 annually in dividends may have invested $1 million or more. The income looks impressive. The capital requirement is often hidden. This creates a dangerous illusion. People start believing dividends created the wealth. In reality, wealth created the dividends. The portfolio came first, the income came later, and that's a crucial distinction. Chapter 5. What happened during 2008? Now let's talk about risk, because dividends are not guaranteed. The 2008 financial crisis taught investors a painful lesson. Major banks reduced or eliminated dividends. Companies once considered safe suddenly stopped paying shareholders. Investors who depended heavily on those payments found themselves in trouble. Income disappeared. Expenses didn't. That's the problem with relying entirely on dividends. You don't control the businesses. Management does. And during severe economic stress, protecting the company usually comes before rewarding shareholders. Chapter 6. COVID delivered another reminder. Many investors assumed 2008 was a once-in-a-generation event. Then 2020 arrived. The pandemic disrupted businesses around the world. Again, dividend cuts appeared. Airlines reduced payouts. Hospitality companies struggled. Energy companies came under pressure. Many investors learned the same lesson twice. Dividend income feels stable until it isn't. Chapter 7. The Yield Trap. Now let's discuss one of the biggest mistakes dividend investors make, the yield trap. Imagine one stock yields 4%, another yields 12%. The second looks far more attractive. But sometimes a high yield isn't a gift, it's a warning. A stock's yield rises when its price falls, and prices often fall for a reason. Sometimes the market already sees trouble ahead. Revenue declines, debt increases, profits shrink. Investors ignore the warming signs because the yield looks irresistible. Then the dividend gets cut, and both the income and stock price collapse. The investor loses twice. Chapter 8. The Hidden Enemy Called Inflation. Now imagine you've achieved your dream. You're earning $50,000 annually from dividends. Life is good. Then inflation arrives. 5 years later, groceries cost more, housing costs more, healthcare costs more, travel costs more. Your dividend income might stay the same, but your purchasing power declines. That's why successful dividend investors don't just chase yield, they look for dividend growth. Companies that regularly increase payouts help investors keep pace with inflation. Without growth, inflation slowly erodes financial freedom. Chapter 9. Taxes Nobody Talks About. There's another reality many dividend videos ignore: taxes. Dividend payments often create taxable income. That means every payout may trigger a tax bill. The exact impact depends on where you live and what type of account you're using, but the principle remains the same. Your dividend yield isn't necessarily your real yield. Taxes reduce what actually reaches your pocket, and over decades, that difference can become enormous. Chapter 10. Dividend Aristocrats. At this point, you might be wondering, are any dividend stocks actually reliable? Some are more reliable than others. This is where dividend aristocrats enter the conversation. These are companies that have increased their dividends year after year for decades. Not 1 year, not 5 years, decades. Think about how difficult that is. These companies survived recessions, inflation, market crashes, financial crises, yet continued rewarding shareholders. Nothing is guaranteed, but consistency matters, and history often provides clues about resilience. Chapter 11. The 4% Rule versus Dividends. Many retirees compare dividend investing to the famous 4% rule. The 4% rule suggests that retirees can withdraw roughly 4% of their portfolio annually without immediately running out of money. Notice something interesting. The math looks remarkably similar. Whether you're withdrawing 4% or collecting a 4% dividend yield, the required portfolio sizes are often comparable. The difference is flexibility. Dividend investors rely on corporate payouts. Withdrawal strategies rely on selling assets. Both approaches have strengths and weaknesses. Neither is perfect. Chapter 12. Why Warren Buffett barely talks about dividends. This may surprise people. One of the greatest investors in history rarely emphasizes dividends. Why? Because Buffett focuses on owning productive assets, businesses, cash flow, growth, competitive advantages. He cares more about what an asset can become than what it pays today. That's an important lesson. The richest investors often focus on total return, not just income. Chapter 13. How wealthy people actually generate cash flow. This is where the story changes. Most wealthy people don't rely on a single income source. They combine business ownership, real estate, stocks, bonds, private investments, royalties, partnerships. Dividends are just one piece of a much larger machine. The internet often presents dividends as the entire strategy. In reality, they're usually one tool among many. Chapter 14. The Sequence of Return Problem. Imagine retiring right before a market crash. Your portfolio suddenly falls 30%. Dividend income may decline. Asset values drop. Confidence disappears. This is known as sequence of return risk. Bad market conditions early in retirement can create enormous pressure. Even good strategies can fail when timing becomes unfavorable. That's why diversification matters, and why financial freedom is rarely as simple as collecting dividends forever. Final chapter. The truth. So can you live off dividend income? Absolutely. Thousands of people do. But the internet often sells the destination while hiding the journey. The screenshot gets attention. The decade of asset building does not. The dividend payment gets celebrated. The years of saving rarely do. And that's why so many people misunderstand dividend investing. Dividends are not a shortcut. They're not a cheat code. They're not financial magic. They are simply one way productive assets reward their owners. The real challenge is not collecting dividends. The real challenge is owning enough productive assets to make those dividends meaningful. Because dividends don't create wealth. Wealth creates dividends. And once you understand that distinction, everything changes. You stop obsessing over passive income. You start focusing on ownership. You stop chasing payouts. You start building assets. And that's usually the moment financial freedom stops being a fantasy and starts becoming a plan. The question is no longer, how much dividend income can I earn next month? The real question is, how many productive assets can I own 10 years from now? Because that's the question that determines whether you'll eventually live off dividends or spend your life